Hello, I'm Noel Lim on ASEAN Speaks by Maybank. Last Thursday, the Monetary Authority of Singapore, or MAS, tightened monetary policy to contain inflation and ensure medium-term price stability. This is the fourth round of tightening since last October and falls outside of MAS's normal cycle of policy reviews, which are typically in April and October. How will this impact economic growth and inflation in Singapore? Suhaimi Ilias, Group Chief Economist, discusses this headline, other central bank moves in the region, and the direction of currencies during a recession-inflation.
Good morning, everyone. A quick roundup of last week. US stock markets were volatile and ended lower last week amid rising risk of US recession after 10-year US Treasury yield fell last week. That led to the 2-year, 10-year yield curve inversion. Key economic data from US released last week included US June CPI, which rose 9.1% year-on-year, the highest since 1981. Meanwhile, China's second quarter GDP growth slumped to 0.4% year-on-year versus 4.8% year-on-year in first quarter due to the spring lockdowns. Although monthly economic indicators like PMI, industrial productions, fixed asset investment and retail sales point to China's economy rebounding in June from the slumps in April and May. But there are reports of continuing problem in China's property sectors as growing numbers of home buyers refuse to pay mortgages for unfinished homes. In Europe, stock market and bond yields fell, and euro hit parity against dollar for the first time in 2 decades as recession worries grew over risk of Russia cutting off gas supplies by not reopening Nord Stream 1 gas pipeline currently under maintenance. Sentiment were also weighed down by political uncertainties. UK ruling Conservative Party is going through the internal process of appointing new Prime Minister following Boris Johnson's resignations, and Italy's coalition government collapsed and Prime Minister Mario Draghi resigned. The IMF said it will cut its global growth forecast substantially, and IMF World Economic Outlook update will be out on 26th of July. Over in Japan, Bank of Japan reiterated commitments to ultra-loose monetary policy, saying that it will not hesitate to take additional easing steps. With BOJ's continued dovish stand diverging from the aggressive tightening by the US Fed, the yen hit a fresh 24-year low last week and ended around 139 against the US dollar from 136 in the prior week. Last week also saw a lot of actions by central banks. Bank of Canada raised interest rate by 100 basis points. Monetary Authority of Singapore, MAS, tightened its policy for the fourth time via a second unscheduled review. Central banks of Philippines also had unscheduled monetary policy meeting and raised its policy rate by 75 basis points. And the likes of Reserve Bank of New Zealand and Bank of Korea raised their rates by 50 basis points. Key data in event to watch out this week include inflation numbers for June for Eurozone and UK on Tuesday and Wednesday. And we have ECB and Bank Indonesia monetary policy meetings on Thursday and Malaysia's June CPI on Friday. So today we have Habin, Zamros, and Winson to chat about rates. Dewey will share with us her second half 2022 macro outlook for Indonesia. Andy will go through the latest ASEAN X macro report on FX. We also have Daphne and Sevi to run through Philippines consumer and REIT sector. Habin, we have fourth round and second surprise off-cycle monetary policy tightening by MAS. Can you elaborate on three things? Number one, the details of MAS policy change and how does that compares with the previous tightenings? Secondly, the justification for the latest move from growth and inflation point of view. And third, what is your expectation on the next scheduled policy review in October?
Hey, hi, morning, Suhaimi. Yeah, so the MAS surprise with a fourth move and a second surprise off-cycle move to contain inflation. This time, the MAS recentered the senior band up to its prevailing level. We estimate the recentering to be about 1.5% above the previous midpoint, and they left the slope and the width of the band unchanged. This tightening move follows up from the double move they made in April. That's a recentering and increase in slope, and also the January intermeeting move. The justification, I guess MAS is very concerned about the inflation overshoot, and that seems to be outweighing that of a growth slowdown. They are revising up the core inflation now to 3.5%. I mean, on average, that's 3 to 4%. And the headline, they also moved it up now to 5 to 6%, another half percentage point move. In particular, I think they warn that core inflation, the latest figure being 3.6, will actually breach 4% in the near term. So I guess we'll watch out for that when June and July figures comes up. But again, risks are onto the upside for inflation given the low commodity price shock and domestic wage pressures. On the growth side, growth is holding up fairly well in the second quarter, 4.8%. Though on a Q-on-Q basis, it is zero. So there are signs of a slowdown, especially on the trade-related services. We think that the MAS and the government basically is warning of a sharp slowdown ahead in the second half. And we think that growth could slow down to around only 1.5% essentially in the second half. No recession yet, but clearly that's going to weigh on the economy with what's going on in terms of the war, the lockdowns in China, as well as the Fed sharp rate increases. In terms of the next meeting, meeting will be in October. We're expecting actually MAS to maintain the current stance unless core inflation really surprises on the upside again, but we think that's unlikely. In part because commodity prices have been falling. If you look at the UN food price index, it's actually fallen to a 4-month low on recession fears. All prices are also down some 18% from their peaks. The only upside, I think, is really about the tight labor market. The concerns that the wages are going to stay high. Last wage growth figure for Singapore in the first quarter was actually 7%. So I think the guidance is probably about 6% wage growth for this year. Domestically, there are all sorts of institutional changes as well. Bear in mind that Singapore will be introducing some kind of a local qualifying wages of de facto minimum wage come September for the lower income workers. And they'll also be expanding the progressive wage model, which is like a tiering of a minimum wage for the retail sector in September as well. And that's probably going to keep the wage cost pressures pretty high.
Thanks, Bin. Let's move on to Zamros. BSP also had unscheduled monetary policy meeting that concluded with a surprise 75 basis point interest rate hike after the earlier 2 rounds of 25 basis point hike. What causes BSP to accelerate the pace of its rate hike? Where do you see Philippines benchmark interest rate will be by end of the year?
Hi, morning, Suhaimi. Morning, everyone. Yeah, BSP on last Thursday, unexpectedly in an unscheduled meeting, raised the policy interest rates by 75 basis point. It's currently at 3.25%. This is the third rate hike so far this year, with total 125 basis point rate hike. The biggest since the 50 basis point rate hike each in August and September in 2018. Just to highlight 2 things from the BSP's monetary policy statement. The first thing is the BSP is looking at the economy now is on a strong footing. So that's why they are looking at the economy to be able to absorb the latest interest rate hike. Already in the first quarter this year, the economy expanded 8.3%. Unemployment rate for the first 5 months was already at 6.1%, improvement from the 7.8% average last year. And PMI manufacturing is already staying above 50 since September last year. It's currently at 53.8 in June. And on top of that, we also have the loan growth, very healthy loan growth at 10.4% in May. That makes the first 5 months loan growth of 9.1% average for the period. So that's the first thing. The second thing is on inflation expectations. BSP also emphasizes on the importance of to manage inflation expectation, especially to the anchoring the inflation expectations. And on top of that, we also have the output gap, which is already balanced in the first quarter. Then BSP expect this to be neutral in the coming months. And also BSP, on top of the monetary policy adjustment, they continue to support the non-monetary measures by the government to especially to address the supply side issues. So with that, we now expect the XP to front load and brought forward interest rate hike this year for another 75 basis point to 4%, with inflation average this year expected to continue to stay above BSP's target range of between 2 to 4%.
I guess a concern for BSP also is Philippines peso, which I think have dropped like 10% against dollar year to date. But Zamros, BSP has been very candid about signaling rate hikes. So what's the latest guidance by the central bank?
Yeah, BSP has been saying that any further adjustment in their policy interest rates is going to be data dependent and going to be data driven. But actually, at the early of this month, the new governor, Madala, did say that BSP is not ruling out to push up the policy interest rate to 4% by the end of this year. So that's sort of the view taken by BSP.
All right, thanks. Still on rates, Winson, we know with continued strong job reports and US monthly inflation rate surprising on the upside in the past 4 months, which also saw Fed ratcheting up its rate hike quantum from 25 bips in March to 50 bips in May and 75 bips in June. So what's the current expectation on the size of Fed fund rate hike at the upcoming FOMC meeting? I think that's going to happen on 26, 27 July. And secondly, how do you see Fed fund rate hike path shaping for the rest of the year, and what would be the impact to the bond market, especially US Treasury and MGS?
Hi, morning, Suhaimi. For the FOMC meeting later this month, I think it is going to be at least 75 bp. As we know, the Fed started the rate tightening cycle late in this cycle, and this has put them in a very difficult position for having to tighten more aggressively than they should. But they need to be careful of not overdoing it. Currently, inflation is too high in the US, and the labor market condition is still tight. So I think they will likely have to go with a minimum of 75 bp later this month, if not more. At one point, the market was actually betting on a larger 100 bp hike, pricing in almost 75% probability at the peak, but now it has fallen back to about 20% probability for a 100 bp hike, because some of the more hawkish FOMC members like Chris Waller and James Bullard indicated that they prefer a 75 bp hike instead. In terms of the outlook on bonds, US Treasuries and Malaysia MGS, I think the key theme on bond yield, whether it goes higher or lower, is still going to be a balance of risk between inflation and recession. And we still think the market is overpricing inflation fear while underpricing US recession risk, as what we have been arguing over the past 1 to 2 months. And what I find last week, market movement on bond yield was interesting. For example, the Bank of Canada hike rate by 100 bp, even more aggressive than what the consensus expect. But the sovereign yield of Canada actually dropped and the curve moved flattened. Also, the US CPI number was very high, higher than consensus, but the 10-year US yield actually fell 15 bp and long duration rally. And I think what this is telling us is the market is finally taking a more balanced view between inflation fear and recession risk. The Fed can hike Fed funds rate still all the way to 4% if they want to, but it doesn't mean the 10-year yield will have to go to 4%. And I think it should be much lower than that, because a more aggressive Fed will only deepen the yield curve inversion. We see the currently strong US labor market condition as a sign of late cycle rather than strength. In the past 7 to 8 US economic cycles since the 1960s, US unemployment rate reached the lowest point in the cycle, on average about 12 months, less than 12 months before the start of next recession. So in short, we are still mildly bullish on both US Treasuries and Malaysia MGS. I think investors should position for a compressed cycle, a shorter cycle, and we forecast 10-year US yield will fall to 2.5% by the end of 2022, and also 10-year MGS to fall to 3.75 by the end of 2022. But I have to say these are non-consensus views.
Winson, we will get back to you on your forecast on US 10-year Treasury yield and MGS 10-year yield later. Juye, you wrote a mid-year outlook on Indonesian economy. What are the key highlights and takeaways from your latest assessments on Indonesia's macro, including your view on Bank Indonesia's monetary policy outlook, as BI has been holding back from tightening, unlike its peers in Singapore, Malaysia, and Indonesia? Sorry,
Good morning. Yeah, morning everyone. So I think to highlight three key takeaways from the report. Firstly, on the GDP growth forecast, we maintain 2022 forecast at 5.1%. Domestic demand is extending its robust recovery. Consumer confidence in Indonesia has soared to a new record high in May and June. Car sales and property transactions have benefited from the government's COVID stimulus measures, but this may ease in the second half when some of the incentives expire. Visitor arrivals rose to 184,000 in May. That's around a quarter of pre-pandemic levels with the relaxation of borders. And also on the investment front, both domestic and foreign investment realization are surging. Secondly, on our inflation and policy rate outlook, we raised our average headline CPI forecast for this year slightly to 3.9% from the previous 3.7%. This is to account for higher food prices and further hikes in unsubsidized fuel and LPG prices. Headline CPI is expected to rise to around 4.7% in the second half of the year, compared to the 3% in the first half. As you mentioned, BI is among the few remaining central banks yet to tighten, but we expect 75 bps in the second half, probably in August or September for the first hike rather than the upcoming meeting this Thursday, to contain core inflation and to support the rupiah. I just want to highlight here that a risk of a sharp fuel price hike remains if global oil price stays elevated in the second half of the year. Recall that Indonesia had added almost 2% of GDP worth of energy subsidies for this year. And while this may be sufficient to cover the rising subsidy burden for this year, it may be challenging to maintain such large subsidies in 2023. The Pertamina CEO has stated that the market prices for subsidized fuel like Pertalite and solar have more than doubled compared to the subsidized prices as of July. There possibly may be a fuel price hike in the second half of the year to avoid any hike in 2023 ahead of the elections in February 2024. Our previous estimate is for a 15 to 20% hike in Pertalite, which accounts for the dominant share of fuel consumption. That could add around 1 to 1.5 percentage point to headline CPI. And in that case, that could prompt BI to hike more aggressively. Lastly, I just want to highlight the point that commodity windfall has boosted Indonesia's exports and fiscal revenue. Commodity prices such as palm oil, coal, nickel, and copper have driven up exports, which rose by 37% in the first half of the year. And fiscal revenue has also surged by 47% in the first months of this year. That resulted in the government upgrading their fiscal outlook for the second time. They are looking at fiscal deficit to come in at 3.9% of GDP, compared to their previous estimate of 4.5% of GDP. We adjust our fiscal deficit forecast to 4% of GDP in 2022, while keeping 2023 at 3% of GDP. The strength in exports and fiscal revenue may be difficult to sustain in 2023 if commodity prices continue coming down from their highs.
Let's quickly move to FX. Andy, FX research team wrote for the latest ASEAN X macro, and interestingly titled Trading the Recession-Inflation Dynamics. So where and how do you see major and ASEAN currencies heading and behaving at a time of rising recession risk caused by this environment of rising inflation and interest rates? I mean, do historical analysis offer any insight, or as usual, famous last word, is it different this time?
Morning, Suhaimi, and morning, everyone. Yes, so recession risks have definitely seen a sharp repricing, I think, over the past few months and the past few weeks in particular. And I think what Winson and Bin and others have shared earlier on this morning highlights that the shifts between inflation and recession. But let me focus on three things from the report because the report covers quite a bit. And indeed, Suhaimi, you mentioned about the historical analysis that's important to see whether in the past specific currencies moved in a certain way or certain magnitude, and whether this time around it will happen. So I'll break it down into three: the US dollar, the yen, and then the Asia ex-Japan. On the dollar side, dollar strength has been a function of better US data actually, and also hawkish Fed, which is what we're seeing so far, but also because of the sharp depreciation in the euro, sterling, and to some extent, the growing fears of global recession emanating out of US and also the Eurozone side of things. But we look for signs of actually slowing pace of the US dollar gains, or potentially a moderate retracement by about 3 to 5% in the dollar strength in the coming months. There needs to be three things on the dollar front that will align for some pullbacks. First is the US data. You want to look out that whether US inflationary pressures will ease, and so it will lead to some dollar softness. Second is Fed signaling is also important. We want to see whether the upcoming FOMC will see a final of 75 basis points hike. So if more officials hint at 50 or 25 basis points hikes for the remainder of FOMC meetings, that will lead to the dollar move a bit softer. And third is how the euro. So another major to look out for, how it copes is important. Whether the euro depreciation will be largely driven by markets and doubts about ECB's anti-fragmentation rule, and the upcoming ECB meeting this week will be critical on several fronts, whether it moves 25 basis points, the anti-fragmentation. So our view is on the dollar front, dollar positioning is on a near multi-year high, and we probably might start to see some gradual unwinding towards the end of the year. Historical price action suggests that further unwinding in dollar longs could see DXY or dollar index price action actually play a bit of a catch down. So that's on the dollar front. Second is on the yen. Typically, there is a slight difference here with historical moves. Typically appreciates, the yen typically appreciates during past periods of sort of recession or worries of recession or crisis. S&P 500 sell-offs will be a proxy. But the current episode is a bit rare as yen was the biggest loser. It moved about 18%. The unusual occurrence was due to probably the sharp widening in the yield differentials relative to the yen and BOJ stuck to a accommodative policy. But I think most central banks, including the Fed, also dramatically step up the pace of the policy tightening. So we think that the pace of yen depreciation could actually slow if indeed growth scares materializes into growth downturns or recessions, because I think yen would tend to see some safe haven moves into the yen front. So our view is on that front on the yen, which have defied safe haven characteristic. It could, as it was also more than what we expected, but we think that there could be some movements into the yen as the short positions are starting to see gradual unwinding. Lastly, the current episode, Asia ex-Japan sell-off is still ongoing. We think as we speak, if you look at historical, the sell-off usually depreciates by about 3 to 13% on average during periods of sell-offs. But this sell-off is possibly still picking up pace because we're only averaging about 7.6%. So if we might see some room for further AXJ decline or Asia ex-Japan decline if recession fears materializes and macro fundamentals weakens further. So in summary, we think that in light of the recession fears materializing, historical sort of analysis or background actually provides some elements, but there's some slight differences. Our view is yen weakness could reverse as yield differentials narrow at some point. The bearish bias could still persist in pro-cyclical FX, including Korean won, Thai baht, and Taiwan dollar. Third, growth slowdown should also see demand for oil coming off, and that could exert pressure on net oil exporter FX such as ringgit. And finally, Sing dollar could still see a bit stay better bit because of the recent move and expectations of appreciation relative to other Asian FX. Suhaimi, that's all. Thanks.
Thanks, Andy. Let's move to Philippines, and this time more on the sectors and stocks. Daphne, how do you see Philippines consumer sector now in light of surging inflation and weaker peso? I mean, in terms of your stock coverage, who do you see as benefiting, resilient and vulnerable, and what's your recommendations to investors?
Thanks, Jaime. So in general, a weak peso is generally unfavorable for the sector because 50% of most FMCG manufacturers' cost of goods sold are non-peso denominated, which implies limited ability to pass on higher costs without losing market share. So a weak peso and rising inflation are key sector headwinds, reinforcing our neutral sector view. At our 2022 and 2023 FX assumption of 55 to $1, the 2022 and 2023 earnings of our coverage names fall by 1% for every 1 peso depreciation in the peso against the dollar. So the 2022 earnings of URC, CNPF, and Monde would be most impacted, contracting by as much as 1.9%, 2.3%, and 1.9% respectively, as 50% of their raw materials are non-peso denominated, while their international business account for only 20 to 25% of revenues. So while the weak peso in 2018 also spurred cost hikes, companies were able to pass on most, if not all, of the incremental cost to consumers, whose purchasing power improved with the passing of the train law, which reduced personal income tax in the same year. This will not be the case in 2022 and 2023 as household incomes remain constrained coming off the pandemic. And the government is proposing further reductions in the personal income tax to be deferred. So given this, we recommend positioning in consumer companies with strong ability to pass on higher costs, such as DNL and to some extent Pure Gold and RHI.
Thanks, Daphne. Another sector that I suppose is kind of sensitive to interest rates would be Philippines REITs. Now, following BSP recent rate hike that accelerated last week, and given the BSP rate outlook for the rest of the year, what's the impact to Philippines REIT sector and implication on your sector view and recommendations?
Good morning. I think we can look at it in two ways. The first is in terms of the P&L or the earnings. The REIT sector is fairly under-leveraged with the average net gearing at 0.2 times. If you take it as a percentage of deposited property value, it's about 11%. So the impact of 100 bips increase in the effective interest rates of the REITs results in only a 1 to 3% decrease in our earnings estimates. Now, if we adjust our risk-free rate estimate, which we have at 4%, then adding 100 bips to the risk-free rate while keeping the market risk premium constant leads to about an 8 to 9% decline in our target price. That said, there's some resilience as far as the earnings. We're still positive on that basis. We think that there's little refinancing risk because most of the debt maturities are still beyond 2023. And then there's the optionality provided by equity funding, specifically via property for share swap. At the same time, there's the upside risk, or the, I would say, tangible upside risk from asset infusions, as only 20 to 25% of the parent company's commercial portfolios have been infused into the REITs. Overall, we're still positive on the sector.
Thanks, Sevi. Let's move to Chee Ting. Chee Ting, CPO price have corrected significantly. Couple of things. First, can you update on the salient price and market moving developments, as well as any policy events that happen or are coming? And what is your advice to investors when it comes to regional plantations?
Morning, Suhaimi. So the market has been pretty bearish the last month as CPO price has fallen about 40% from around 6,000 ringgit per ton just a month ago to right now 3,560 ringgit per ton last Friday. Besides expectations of favorable yield following good oilseeds planting progress in the Northern Hemisphere and further hike in US Fed rates to tame inflation, the other key factors that has been dragging down CPO price of late has been the bloated palm oil inventories in Indonesia that has piled up since Indonesia imposed a 3-week export ban in May and other measures to restrict exports since then. Indonesia's bloated stockpile is estimated to be above 8.5 million ton, double the usual 3 to 4 million ton stockpile. So after months of trying to bring down domestic CPO price in Indonesia to provide affordable cooking oil to the masses, the government is now rolling out measures to boost the demand of palm oil as prices have hit recent lows. Over the past 3 weeks, the Indonesian government announced 3 key measures aimed at boosting demand exports. Firstly, the Indonesian government lifted its domestic versus export ratio from 1:5 to 1:7 ratio effective 1st July. This simply means exporters can now export palm oil at a rate of 7 times their domestic sales, or better known as the domestic market obligation. Secondly, the Indonesian government plans to implement B35 biodiesel plan starting 20th July. Currently, it's B30. This, if it happens, translates to additional 0.15 million ton of CPO usage a month by our estimate. Last but not least, over the weekend, just this weekend, the Indonesian government announced a temporary waiver of export levy from 15 July to 31st August. The export levy is now cut to zero for CPO from $200 per ton starting 15 July. It is important to note that the export duty remains in force, which is at $288 per ton. Nonetheless, with the export levy waiver, the export tax have been immediately reduced from 488 to 288 right now, or about 200 ringgit for the month of, $200 per ton for the month of July. While these measures will bring Indonesia's floater stockpile, will help to reduce Indonesia's stockpile, we believe it may still take at least 2 months for inventories to normalize, as Indonesia is now entering its seasonal peak production cycle in second half. As long as the market believes Indonesia continues to have bloated stockpile, it will continue to weigh down on global CPO price. Hence, CPO price is likely to stay low in third quarter of this year before recovering towards fourth quarter and into the first quarter of next year when the industry enters into seasonal low output cycle. In the meantime, all eyes will be on the weather condition and crop development in the Northern Hemisphere, especially in the month of July and August, and a fresh guidance by the US Fed later this month for new price direction. For now, we expect CPO price in second half to trend lower half and half. Our preferred picks are integrated players with relatively low cost of production, such as IOI and KLK, as they typically exhibit greater earnings resilience compared to pure growers, given the latter's earnings are more sensitive to CPO price movement. Hence, our regional preferred picks are KLK and IOI.
Our CPO ASP forecast still unchanged for this year, next year?
Yeah, it's still unchanged. It's on track to be to average 5,000 ringgit per ton this year, and next year at 3,400 ringgit per ton.
All right, thanks. So we slightly overrun, so that's a wrap for today, and have a good week ahead.
As always, get specific advice from your trading rep and download our reports from the Maybank Trade app. Also follow us on Spotify and Apple Podcasts to get immediate updates. Have a good week ahead. I'm Noelle Lim on ASEAN Speaks by Maybank.